What are your favourite entry and exit methods?
I think that if I was going to pick one methodology, I would look at a gentleman by the name of H.M. Gartley. He wrote a book in 1930 called Profits in the Stock Market. I found the book on the Tottenham Court Road one Friday night, a wet Friday night, and I was wandering as I do at the, those second-hand bookshops on the Tottenham Court Road, Charing Cross Road there, and I saw this book and it was signed by Gartley himself, at least somebody who said it was Gartley. And it's an absolute gem, and in the book, on page 222 there's a pattern, and the pattern is called a Gartley 222, and it's very, very similar to Richard Wyckoff's upthrust, and they produced this work. There was no internet in those days, people didn't know each other, so they produced the work independently. So a Gartley 222 is a thrust up the page and then a three-wave pullback. It's got some geometrical characteristics, and I think that anybody listening can find details of it on the internet. There's quite a bit of it out there, but that's my favorite entry tool. So a bullish Gartley is a thrust and a three-wave back, and there's geometry. It normally stops at 61% or 78% of the upthrust, and a bearish Gartley is down and then three legs up. So you're selling at a really, really good level, and those are my two best entries. Now the bullish Gartley and the Wyckoff spring are pretty much the same thing, okay, except that Wyckoff didn't look at a great deal of Fibonacci analysis. And similarly, the bearish Gartley and the Wyckoff upthrust are pretty much the same thing. Okay, the gist is the same. So those are my two favorite entries, and I say it with my trading partner, we say it all the time: why don't we just sit and wait for Gartleys to pitch up? There are some other patterns as well. These are Fibonacci based patterns. There is a pattern called a three drives pattern, and I traded it the other day on a daily chart of the dollar against the Canadian dollar. And this is a pattern which is counter trend, where the market was falling, there was bullish divergence, and the market in fact drives down 3 times to a low with a great deal of Fibonacci levels there, and I managed to buy the Canadian dollar right at the cusp of the turn. And that fellow that said that technical analysis doesn't work, I would like to show him the chart, okay? It's I don't look competitive, I know, at 61, but it's a great thrill to be able to take those guys on in the city and beat them.
And what's your favourite exit method?
Well, the favourite exit method, again, for me, it would be Fibonacci orientated. On the falling wedge stroke three drives pattern, I have a exit criteria based on geometry, which is proprietary to me, which seems to work, and I've been using it for a very long time. On the Gartley formations, then I want to get in at that 61% pullback after the three legs back, and then I want to add to the position, and then I'm looking for an expansion to 1.618 of the entire pullback for an exit criteria, and that has worked very well. Some of them just fly. For example, that copper trade I talked about just kept on going. It just kept on going. I was stopped out, in fact. I wasn't stopped out. I thought it had been stopped out, but the darn thing just kept on going for weeks and weeks and weeks and ignored all the Fibonacci levels. So Celine Dion did me a favour.
What other technical analysis particulars do you use? So you mentioned Fibonacci. Do you use Bollinger Bands? Any others?
No, I'm not big on Bollinger Bands. I don't know why. No good reason. Not why. I use that 89-day period moving average. I use a lot of Fibonacci, and I use momentum divergence to actually give me a heads up as to when trends are about to change. When a downtrend is about to change to an uptrend, when an uptrend is about to change to a downtrend. It doesn't tell you exactly when it's going to happen. The divergences can drag along along for quite a long time, but it gives you a heads up that the trend is starting to move into thin ice. And volume is very useful if you've got accurate volume. Forex market, for example, doesn't the banks will not give out volume numbers. There is stuff called tick volume that you can get, but the actual volume numbers they keep to themselves. The stock market gives out volume numbers, and volume is really useful in the stock market. If you've got a share that's rising on rising volume, that's good. But if you've got a share that's rising on falling volume, not so good. Okay, so volume and volume divergence is a very strong tool indeed.